At what point do market sell-offs translate into real economic ramifications? Where would it have to go before you would start to see that show up in, say, consumer behavior?
I think actually today on Constitution Avenue in Washington, D.C. at the Federal Reserve, there's probably a sigh of relief. The risk appetite, the market is now finding out, you know what, stocks not only go up, and on top of that, we just eliminated a significant amount of the short selling in vol also, which was essentially also a proxy for picking up yield, which was also a reflection of interest rates being very low for quite some time. So I think the short answer to your question is that for now, I still think that it's very, very early, and I don't think that the implications are very significant. The market is also telling you this, that break-even inflation, if you on your Bloomberg screen type break-even and pick five-year forward break-evens, you will see that break-even inflation expectations really haven't moved much on the back of the last few days. So what's most striking is that we saw a significant reversal in the S&P 500 that's now coming back. So if you look at five-year break-evens, you will see that that's really not moving very far. So that's telling you that the market is not anticipating, to your question, Joe, that this is going to be recessionary or going to have any dramatic downward impact, because then inflation expectations would also have been crashing.
You called it a game changer, though. I saw you quoted as calling it a game changer. What did you mean specifically? Because, Cameron, you wrote today in your piece, some things may have changed, but everything has not. And you say, I'm just trying to find the line here, it would be wrong to call this... do you remember the quote? I just had it a second ago and now I've lost it. It would be erroneous to suggest that this is some kind of game changer.
It's erroneous to say that everything's changed. I mean, what's changed is... the volatility climate. I think we are now moving from a mid-cycle period of low volatility to, if you will, this is ringing the bell, that we're now moving into a late cycle, which is consistent with the policy challenges faced by the Fed. If inflation has become more of an issue moving forwards, that means the Fed might, or certainly the market will contemplate that they might have to move, not because they want to, because they have to.
So I've got the line now, by the same token, saying this changes everything is equally erroneous because it doesn't.
Well, what's very important about that also is that investors used to have now 6-7 years of an environment where interest rates were low, vol was low, and it was a certain set of strategies that worked very well. What is the real wake-up call over the last few days is that now you need to figure out what are the new strategies, because we're now leaving zero and negative interest rates in Europe and low interest rates in the US behind, and therefore you need to figure out, should you still be buying equities in that environment? Should vol still be very low? And the answer is vol should not be low, VIX should be higher. It's a normalization of those trends that we're basically entering that phase, and that's definitely a regime change from where we have been for the last 7 years.
I think what that means is you go from sort of close your eyes, buy and hold, and never have to worry about any sort of drawdown, to maybe it's going to reward a more active approach, both in terms of market timing and in terms of stock picking. So my little statistic is that we went 54 days, ending a couple of days after Thanksgiving, without a 1% move in the S&P. S&P futures had 20 different 1% moves today. Now, if you don't think something has changed when you hear that, well, you never will.
Well, and to that point, everything used to be highly correlated under the zero interest rate regime. And now you're entering a regime, well, now suddenly inflation is one of the main factors that you need to take into account. And if that factor suddenly pops up, then you should no longer just, quote unquote, buy everything. You need to start to differentiate. And that differentiation is actually healthy. Absolutely. I think the Fed will look at this, and the ECB for that matter will look at this and say, we need to have investors that are more skeptical across asset classes, so that it's not just buy everything and all risky assets go up at the same time.
Fear of missing out.